Eric Mwade. In response to your question, I'm going to post a question here just to refresh yourself. And so here's part of the email question. That's the other part of it. And here's the rest of it. So I guess the main question here is when or what, where do you start, or where do you begin when you're looking for a stock or trying to find how you can approach a stock? The question is, where do you begin? It's a good question and probably doesn't have the best answer because there's none, would be my approach to that. So really, in truth, there's no answer. You begin where you begin. And yes, I think the monthly, in my opinion, is probably the best way to begin because it gives you a nice broad picture view. So I still maintain that the monthly should be and can be used as your default setting, even though it's not used a lot by most investors. Nothing wrong with that. But I think the monthly gives you a good overall feel for what is going on. You can trade without the monthly, and for many years actually, I traded for a long time, considering my default setting as being only the weekly, and that there was nothing wrong with that. But I noticed that after a while, it always seemed like there was something missing in terms of stocks would behave, markets would behave, instruments would behave in ways that when I look back, had I considered the bigger picture being the monthly, some of the things would have been very obvious that were not being captured by this weekly chart viewpoint. So for some reason, I've always been more interested in the weeklies, and then eventually down the road, I'll call it about 5 years ago, I came across the use of the monthly chart in just consolidating the whole picture. If you take away the monthly, you can still trade well, but I think if you do not consider at least the weekly, boy, it becomes a little bit a very narrow view, and something that would be going on the weekly that you miss and you're only considering the daily could not explain what you're seeing on your chart, and why performance is not what you'd like it to be. Now, the one thing I've also come to notice, and it makes a lot of sense, is if you don't consider the monthly chart, or I guess what I'm trying to say is that if we have all these time frames, so we have the weekly, the daily, and the hourly mainly, and some people go to the minute chart, so it's minute chart. All these views are different, but you'll always notice that over time, if you go against the monthly chart, you're gonna lose. And if you go against, so in terms of importance, is eventually markets will go in order of the bigger time frame. So the bigger time frame tends to win, because if the monthly says the market is, let's say, bearish, but your minute chart says the market is bullish, you might be right in that the market might go up for the next 10 minutes. But over the next week, month or so, the market might eventually come back and give respect to this down view in the monthly chart. So generally speaking, the bigger time frame tends to win. And if that's the case, for example, if I have a fight going on between what I see on the weekly and on the daily, if I really have to take one side of the argument, maybe the dailies are saying markets are going up and weeklies are saying markets are coming down, or dailies, so weekly saying market is going up, daily saying the opposite, or whichever. Whenever there's a fight between the weeklies and the dailies, for example, you'd rather go with the bigger time frame, because the bigger time frame eventually outweighs the smaller time frame. So if that's the case, then through reasoning, it seems the best thing to do is go with this monthly view as your default. So again, to answer your question, where do you begin? I think you begin with the monthly, and if you don't want to begin with the monthly for whatever reason, you can always begin with your weekly chart for sure, and then maybe refer to your monthly. So to begin, you begin with a bigger time frame. That would be my best answer. But I also do know that just like that example, we take it to the dating world. Whenever you meet somebody, there are no rules as to where to begin. You know, you just begin where you begin. So that the same thing also holds with the stock market. You can actually begin wherever. There's no hard science, there's no hard rule as to where to begin. And so just the same rules that could hold to, for example, a situation, you eventually end up being, you know, close to somebody. You don't know where it begins, how, it just happens. And so whenever you're looking at a stock or any stock chart, and in this particular example we're looking at TASR, you can begin anywhere. So that's, I think, my best answer is you want to begin with the bigger time frames just because they tend to outweigh the smaller time frame, generally speaking. Even though in truth, and this is a truth, that what happens on the minute chart eventually influences what's going on the hourly, which in turn influences what's going on the daily, which influences what's going on the weekly, which again influences what's going on the monthly charts. So in a way, we're in some type of, everything is influencing everything. Macro movement also affects micro movement. But I think if you're really going to make a determination as to where, because I'm doing my best to answer your question, I would begin here with the monthly chart. And now in relation to your other question, which is a good question, a logical good question, and it raises the question as to why wait for a breakout. Let's take an example here. Why wait to buy the stock here, which in this particular example was successful? Not all breakouts are successful. So, but in this instance, there's a breakout here. The question is, why buy here if you can find a reason to buy here? And that is correct. Why buy higher when you can buy it lower? And I think that's one of the negatives of buying the momentum trade. And I will explain to you, I'll give you an answer that probably you are not expecting. And the problem is share numbers. We are looking at a market with, let's call it, so we're looking at a market that has thousands, I believe about 10,000 stocks. That assumes you're not trading other variables, other instruments. So if you're looking at stock market by itself, you're looking at 10,000 individual stock names, maybe even more. Now if you look at this from a just sheer opportunity standpoint, is how do you know which of these 10,000 instruments are moving? So to answer your question as to why it is that people tend, or a lot of traders over the years have come to embrace the breakout strategy, the reason is very simple, is unless you have a way, and there are instruments and software that can do that for you, to give you signals. For example, during pullbacks, you're looking at just the numbers. There's so many charts to look and consider that it makes more sense to find a group of stocks. And let me show you an example here. So this is what the list of stocks I am watching, and as an example, it's just an example. I have right now, see whether I can show you how many are on this list right here. So you can see there are 549 ideas. I trim this list, I add this list. I've been keeping this list of stock by trimming it over a period of the last 10 years. I remove what I don't like, I add new ideas every day. But because I cannot go through all these stocks, we're talking about almost 600 stocks, I cannot go through them every day. That would be too much work. It's too many variables, too many stock charts. So the reason why you're probably going to find yourself looking at breakouts eventually unless you're looking at a smaller group of stocks. Let's say you've identified 3 names you want to own, or 5 stocks. Now you can go through those stocks every day and look at them to see how the charts are doing, and they might present you with an opportunity to buy them on the dip. But as an example, since I run the subscription website, I cannot spend all that time looking for just a couple of stocks. I have to look at a broader picture. And so it makes more sense to set an alert. So for example, right now, let's take a real life example. Let's take a look at TASR. So TASR is off my list right now in terms of buy candidate, but I might set an alert for about $27. If it ever comes back to $27, I know it's breaking out. But because I don't know whether it's going to stop here in the 20s or in the mid-teens, or it's going to come back to 7 or maybe even to 0, I don't know where it's going to bounce. I cannot set a price alert. Yes, I can. There's nothing wrong. Maybe I can set a price alert. As an example, if it comes back to this previous buy point, so $19, it's an example. I can set an alert. Oh, take a look at TASR if it comes back to 19, sure. But if I was to do that to all the stocks in the market, I would be busy all day responding to alerts. So to answer your question, if you have a group of stocks, let's call it 10 stocks, then maybe you can look at the individual charts every day. And maybe that's the advantage of being a retail trader, is all you need to do is find a couple of stocks and follow them week to week, day to day. Maybe you can get this opportunity here to buy before the eventual breakout. I, on the other hand, almost have to wait for this breakout past a predetermined entry level because of the sheer numbers of stocks that I'm following. And I do my best when I'm going through looking at the charts during the day to find opportunities where stocks are pulling back. And that might be another thing you can do. So while you're going through the day looking at ideas that come through you from all sorts of places, the best thing to do is, if you see a stock that is giving you a level or a chart idea that could be in a bounce possibility. Let me give you one example here, what I'm talking about. Just this morning, I was looking at a stock as a breakout candidate. I've been following this stock, trying to see how we can time it. It's been doing well the last couple of months. All right, IPO'd here at about $7 or started trading at $7.50. Has gone all the way to $50. So there have been a couple of breakouts, for example here at 15, another breakout here, so at 7, I'll call it 15, another breakout here at 22, somewhere around there, and there was another recent breakout here. So I can see that eventually I can set an alert for $50, but I noticed something visually. This is not something either a software alert, is a visual observation, that recently we can see that this acceleration, this move above 69.1 launched a very nice move in the stock. And I can also see that there's a slight breakout here. So that entry there, if I extend that simple straight line, I see that we are bouncing on a previously successful area on this chart. So here was an entry there, and so this entry moved the stock from $22.50, $23 all the way to $50. And so I'm drawing a simple straight line here, and I can see that it's bouncing on the same line. And so I can look at this and say I can go long here before the breakout. And so this is just something I observed while I was going through the progression of looking at the stocks during the day. I also looked at the daily, and I noticed that on the daily we are bouncing on the 50. So if I like the stock for whatever reason, I don't have to wait for the breakout. And I can see that there was a move here, somewhere around here. So this move in the RSI right there began this nice low at about $758, and we know the rest. Stock has done well. So using that information, I draw a simple straight line from this entry level here, like that, you can see that the stock has come back to that level in that general area with uniform activity and bouncing. So I can take a position right now here on the name and with a stop. So the stop would be, for example, at today's low. The low for the day is 42.07. So that's the low. I take a position, and I know that if it moves back below that level, I'm just going to get out of the position, and I have a chance of riding the stock potentially into the breakout. And so that's what I was talking about. Because of the sheer numbers of stocks out there, it is hard to look at every individual stock in the market every day. And so you might be forced to go to the few stocks you are watching. Maybe there are 10 stocks, 20 stocks, 50 stocks. You might have to go through them every day to find similar opportunities. Remember, it's moving today, so the opportunity might be there for this day. Here. There. So this is something happening today, and you can take the position based on today's move. So to answer your question as to why we have to wait for breakouts, the answer is it's just because of the sheer number of opportunities. A stock like this one has a predetermined high. This high is not going to change. Let's call it $50 and change. So that's not changing, and because it doesn't change, if I like the stock, I can set an alert for it to alert me, or the software to alert me if it breaks out down the road. If you get the breakout, I know it's moving higher. The principle is just going back to this prior successful breakout. You set an alert here. So remember, if the stock had made an alert here at $15, when it came here to $7.50, somebody who forgot about the name but set an alert at 15, when it started trying to break out here, you have another reason to have an interest in the stock. And the theory is that if you can buy the breakout, you have a chance of owning, for example, this move here. So that's the principle behind it. It's like, let's say a stock is trading at, give you an example here, and I know I'm rambling along, but that's okay. Let's say a stock is trading at $10. If the stock is ever going to trade at 50, it has to go through 14, has to go through 15, and so on and so on. So the theory behind it is, if a stock is going to see higher prices, it has to go past its resistance level. And so it makes sense to set an alert where the previous high, and when it comes back to the previous high, then you can be alerted of that move. Otherwise, it would be impossible to look at all the stocks in the world every day. But you can set alerts for a few stocks, and you can also be watching a group of stocks that you trim, a group of stocks that you manage, you remove, you add over time, and you can be looking at that group of stocks every day, and when you see an opportunity, you can go into the name. Let me just give you a simple example here, and then I will end the video. Let's go here to my stockchest.com account, and on this I have 300, and this is my daily list of stocks that I track. This is the entire market, all right? 315 stocks. I look at this probably every week, once or twice. So I'll show you as an example. So there's so many stocks on this list, all right? 315. But I know, because I've been watching this, there's one group of stocks, and I'll show you that, because I mentioned this in the weekend video. It is the IYR. So let me go to the IYR. IYR has come back to, now we see that the IYR had moved from here, 68, and had a nice move to $82. And that move began somewhere here. And so if we draw a simple line and extend that, it comes to there. We can see that even though I have 300 and X amount of stocks to watch, and the charts are so many, I know that this is one off head. I know that is bouncing on a critical line. So if I'm looking for an idea to buy a stock on a pullback, I can go to this sector and look for opportunities, the real estate sectors, because I know the ETF itself is finding support on this line. So let's do this again, and then I'll conclude the video here. So we see there's an entry here, that began this nice move here. And so it has come back to this level, so I know that this is probably giving us short-term entry level, just like it did here, for an opportunity for the instrument to move higher. I can back test this by going backwards and see whether that is legit. I go backwards to here, and lo and behold, it was double bottom support here for those lows, and also this entry here came off these lows here. So I know this support here is just not me being, trying to reason or to force myself into a position. It's not an entry with no explanation. The explanation here is that maybe there's an opportunity here for the stock to move higher, so I can take an opportunity here. And so this is just because I noticed this when I was going through the list of stocks I watch every day. Now let's go back to TASR. And on TASR, we were talking about our next buy point is going to have to come from this entry somewhere around the 50. That's going to be our first choice. Second choice is going to be somewhere down the road if it comes back to this level. So either we're going to get uniform activity around here, and then maybe we might start looking at TASR as an interesting bounce, or if that doesn't work, we can wait for the next opportunity here. Remember, I said, to me, we needed to wait because the stock has not given us any reason to go long on the weekly. For example, we haven't seen any reason to go long the stock from a daily, because this move from here to here, a very good percentage gain, almost 100%, began here. Oh, just somewhere there. It's where the RSI started moving. So if we draw a simple straight line like that, we know that the stock needs to give us uniform activity back above the green line. It is not our responsibility, if the stock wants us to own it, it needs to give us uniform activity below the line and back above it. And so until we see uniform activity, we cannot own the name. And so the chart, in my opinion, is telling us we need to wait for an opportunity to present itself visually. Eric Moore, good luck, peace, and blessings. Woo!